markets have corrected. And after all that, I think what we're going to do is put you in a place where you're going to better understand that where we're at right now is another one of those things that actually proves that our investing in the market works. It doesn't take it away. So welcome to the call. So everybody should be seeing my screen. You'll see a wonderful picture of a gentleman named Benjamin Graham. And Benjamin Graham is one of the greatest individual investors to ever exist. Of his day, he was his Warren Buffett. What I loved was his quote that said, investors who have either the enterprise or money to invest now, somewhere near the bottom, are likely to prevail over the investors that wait for the bottom and miss it. Meaning, better to be in than to be waiting. And I think that what we do is sometimes we can take those out of, out of context. Some of the quotes. Last night, I had a chance to share with you a little bit about how my week went. I started the week actually flying out to New York, and Monday afternoon, I'm walking down Wall Street. And this is after the first big correction of the week in the markets. People are worried and wondering what's going to happen. And so I go walking down the Wall Street, and the cameras are out there, and they're interviewing people, and understanding that it's all about the media and it's all about the results that they think are going to happen. Now, in reality, none of the things that they think are going to happen are going to happen. Okay? Not one. But what they are going to do is they're going to consistently tell us that terrible things are going to happen because it feeds the outcome they're looking for, which is ratings. So since 1928, we have had 87 market drops of 10% or more, compared to 23 market drops of 20% or more. Market drops happen. Now, since 1946, it's taken the market just 111 days on average to rise to its pre-crash levels. And the reason historically stocks have returned more than fixed income over time is because of the volatility of the market. So we'll sometimes be in the stock market and say, I want to be out of the stock market because of the very volatility that it has. But if it was not volatile, if there were no ups and downs, then what would happen is there would be no premium on the returns that we generate. That's what we refer to as a risk premium. Many of you have heard me speak about it as compensated risk, that we are getting compensated for the risk that we're taking. If there is no additional risk to the volatility, then so would the attendant wealth created by that volatility change. So put it this way, if stocks just went perfectly up and to the right on a chart, then it would only produce returns similar to that of, say, a CD or a government bond. So what we're going to look at as we do a lot of analysis this afternoon is we're going to focus all on U.S. markets. And so we're going to imagine a hypothetical 70% stock, 30% bond portfolio, but unlike most portfolios, and certainly every portfolio that we build, and we have all kinds of people on the call today, people that are current clients, people that are getting educated as clients, people that are clients of other people that are listening in because they got our email talking about this event for our clients in holding strategy. But rather than this being a worldwide portfolio with stocks from 42 different countries, this portfolio is one country. So we would say worldly diversified or globally diversified portfolio and academically allocated. This is an academically allocated portfolio only in the United States for the purposes of many of the comparisons we're going to make today. Okay? So let's talk about the first one of these most recent, most reticent in most people's minds. Now, many people think of what happened with the crash back in 2007 as actually happening in September of 2008, because that's when it fell. If you looked at the chart, it fell off in a big, big way. But it actually started in November 2007 that it began to slide. It just, the beginning slide wasn't that bad. It lasted 16 months, and the total return of the S&P 500 at that time was negative 50.95%. Negative 50.95%. That is huge amounts of what appears to be totally lost wealth. In fact, if you look at what happened in the market and how people were talking about it, it was as if we were back to soup kitchen lines of the Great Depression. Now, in a moment, I'm going to talk a little bit about why it is the financial media and all other types of media want to draw so much attention to hardships in the stock market. Some of the quotes from 2008 were, mounting fears shake world capital markets as banking giants rush to raise capital. Markets are in disarray as lending locks up. Just end of the world. That was September 18th, 2008. And a new phase in finance, crisis as investors run to safety. It's just going to be horrible. It's never coming back. And if you remember being in those days in late 2008, it was like, my gosh, it is all going to heck in a handbasket. We are never going to see the bottom of this thing. We are forever going to be damaged. The stock market will never be the same. The world will never be the same. And the always present, this time it's different. It's not coming back. Well, let's see what happened. If you had $1, if you had $1 invested back in March of 2009, and you kept that in the market until December of 2013, the full period of the recovery, for every dollar you had in the market, you now have $2.8, $2.80. So yes, if you were purely in the Standard & Poor's 500, you watched a 50% market slide. But if you had a portfolio that was globally diversified and academically allocated, you came back. Now in this case, you'll see two different lines I want to draw your attention to. S&P 500 is the taller line, and our simulated 70-30 U.S.-only portfolio. So everybody talked about how the U.S. market got crushed, and yet our U.S. market-only hypothetical portfolio went just fine. And we returned about $2.50 per dollar invested at the bottom, meaning we wouldn't have known where the bottom was, but all we had to do was stay in, and we recovered. And we got well not only above the pre-crash levels, but we got well above the pre-crash levels. This is often surprising to people. In fact, if we look at that same period of time and we see, well, what is the actual performance of that 70-30 portfolio? Over 1 year, it came back 54% in a single year. And over 3 years, it averaged 22.5%. Amazing. And it did that without any major intervention, because that 70-30 is that passive structured portfolio, the same type of passive structured portfolio we teach our clients to own. So let's look at the next crash, another one that most people on this call will remember. And we're going to go back to the ones that we don't remember but we've heard about. But the next one we remember is the crash of 2001, the tech bubble burst. It lasted 22 months, and the total S&P 500 return was down 36%. Let's put that in perspective. That means if you had $1 million invested in the Standard & Poor's 500 over a 22-month period of time, if you held on, you went from $1 million to less than $640,000. That's hard to hold on. That's one of the reasons why we teach our clients to have globally diversified, academically allocated portfolios, because we need to have a portfolio that won't take that big of a hit when the hits happen. But even if you were just in the S&P 500 and you rode it all the way down, but you watched what was going on, here's some of the things you'd read. We would see things like the bear, once again on the cover of Time magazine. I just want a particular note, some of our team here locally is in the conference room with me as I chat with all of you today. I just want you to notice, this bear has very nice shoes. And check out the cell phone. It's a Motorola StarTAC. That was pretty amazing tech at the time. And yet, you know, what else were they saying at that time? Well, they were saying they have run out of options when it comes to the economy. They're trying to claim things are not bad, but people see right through that, right? Quote on money.com. Next, even if the worst is over and you believe the market is starting to rebound, the recovery you can now expect won't, as in can't or never will, erase the cumulative effects of 3 down years, which was 22 months, but okay. He's going to say 3 down years. What happened? Well, let's just take that up through today. So we're going to take it through today and through the other crash we just assessed. So we're covering it all the way through. If you had $1 back at the beginning of 2003. Well, for one, if you were in the S&P 500, it sure looks like you actually lost by 2009 below what you would have had. Except if you stayed invested the entire time, you actually ended up back for every dollar invested, you had about $2.70, just in that green line, the S&P 500. If you had the simulated 70-30 portfolio, you ended up with $3 for every dollar invested, even though it was quite a ride. Now, here's one thing I want to point out while we're talking about it. If you had your U.S. part of your portfolio performing like this, you would also have had, in a globally diversified, academically allocated portfolio, we would have also had many other countries. And they would have been weighted in our portfolio due to their gross domestic product as it is across 42 developed countries. And when the market went down here, other markets were not as far down, and we would have been rebalancing back to U.S. markets, buying them cheap. So this is not taking that into account at all. This is only U.S., only S&P 500, only the massive amounts of doom that the media is bringing to us about the U.S. markets. Now, I told you I would share with you why it is our industry goes out of its way to try to scare people. Now, certain asset managers go out of their way to try to scare people, and the reason that they do that is they want to have you change your investment strategy and hopefully change it to them. But what they really want to do is drive ratings. So I went to pull up a particular video. I'm going to see if I can pull it up for all of you now. And this is a video of a market timing day trading former Playboy bunny. It actually looks like Fox News is having a little bit of a problem right now. Let me go back to the Google search. And this is dangerous because I'm about to type into a Google search Playboy bunny on a live webinar. I'm really questioning my decision-making ability. Alex McKay, who's on this call today, this is why you should be in the room with me before I do these. Playboy, oh my gosh. How about Fox Business, I got better, Neil Cavuto. Cavuto, okay, good, this will be helpful. Playboy day trader. Okay, I think this will be safe. Okay, so here it is. So here's the video. This Fox News video is not quite displaying right. Here's Playboy Playmate turned day trader. Now, if you watch one of these videos, the most interesting thing about her video is that she actually says, this is in July, she actually says in the video that she's only been day trading since April. She started in April. And the volatility of markets and how it helps her, all that. Here's the thing. It would be ridiculous for anybody to be on national television, anything, saying you should trade individual stocks based upon having a whopping 3 months worth of experience, unless the only thing they're looking to do is to have a very tongue-in-cheek name for the piece, like Playboy Bunny Rides Wild Markets, or what they're working to do is just garner your attention long enough to keep you tuned in and hopefully seeing a commercial. So what we want to be able to do is stay away from the media that's trying to wrap our attention on them. So we see the commercials because they need the ratings. So the worse that they can speak about it, whether it's in times are good, because this is back in July, we're going to bring on a Playboy bunny and have her teach us how to day trade, I would feel totally different. It's not about her being a Playboy bunny, but it is about the fact she's only started in April. Versus if she said, I've actually been doing it ever since I was 16 when I first started modeling or whatever, and here's my returns and here's my strategy, and it is the most fluff interview, but it's all meant to attract our eyes. So if instead we bring disciplined strategy, it has all of the excitement people are trying to rouse us to seem far less important. Talking a little bit about my trip to Wall Street as we go back to the prepared presentation. While I'm getting ready to fly out to New York at 6 a.m. Monday, I got to watch a huge amount of people in first class all keep it on CNN the entire time, watching what was happening with the market. You know, and so we're in the air from the open of the market at 9:30 for 6 hours of the market being open, and so it closed sometime after we landed. Now, I also happened to be up there with a bunch of, strangely enough, pro golfers who had been playing at the championship tour up here in Seattle, and then subsequently were playing in New York after. And all the conversation was like, is this it? Are we going to keep going? And it was like I'm looking around. I'm like, you know, CNN, they got it. Like, this is what they wanted. Everybody's glued in, and then they begin conversations so that they have to go back to the news outlet to see what happened. Also, why do we do that? Because we're designed. We originally built community out of avoiding threats. When we were tribes, you know, just wandering large amounts of vacant land, why would we couple together as a small tribe? Was to defend ourselves from threats, other tribes, wild animals. Well, today we don't have that. We have the, oh my gosh, the market's never going to come back, even though we can look at historical evidence, and even after March of 2003, we had a one-year rate of return of 44%, 20% three-year, 5-year 12.9, and even since the bottom and through the 2007 situation, 2007 through 2013, we still have a 9.49%. So let's go back to 1987, Black Monday. I actually have a friend who joined a wirehouse, a stock brokerage house. He was a stock jockey in 1987. His first day was that day. It lasted 2 months, but over 2 months, the S&P dropped 23.25%. Incidentally, I saw a hand up a few moments ago. I'd love to get back to you. It looked like the hand went down when I went to click on that panel. So if you raise your hand again, I'd be happy to try and chat with you. Although Alex is not in the room with me, so sometimes I wonder if I'm going to be effective at doing that. So down 23%, and this was the front of Time magazine. The world is different because of a 2-month horizon of time, never to be the same. Quotes from then, technically the crash of 87 looks remarkably like the crash of 1929. Now we're going to go back and see it. That is from George Soros. Now, you'll see in a moment that the 1929 crash was years long. This was 2 months. And he's like, yep, it looks just like that one. Why? You notice it's written in a book. What do you think his objective is? Sell the book. What do you expect us to do? Announce that all the cabinet members will be buying IBM and General Motors tomorrow? And that was an administration official trying to, when they're like, well, what can you do to help people feel better? And he's like, what do you want me to do? Say that we're all buying stocks? Because even they were freaked out. The borrowing is stopped. The market slide was a shot in between the eyes that had better wake us up to the simple fact that we can't keep romping forever on borrowed money. Like, it's all going over. Except if you had $1 in the market, and then you went through the tech crash, and then you went through all the way through October of 2007, you now had $10 for every dollar you had in December of 87. That's a 20-year period of time, and that's a great deal of return on our assets. Nobody talks about that in the bottom. They're all talking about how bad it's going to be. Here we have a 20-year rate of return of that 70-30 U.S.-only portfolio of 12%. That's the return we had after the horrible situation happened that everybody thought was going to change the world. Let's go back to 73. 21 months and a 42% rate of return. That's the title of our conversation is After the Crash. What happened after this one? Surely back in 1973, it fell apart and never came back, right? Well, let's take a look. This is the front of Time magazine. Now even nations are in danger of default. You could probably replay the newscast from 74 and replay them for Greece for the last few years. The slide is steep with what? No end in sight. It's never coming back. One of the guys at our firm played a funny joke with me. I wish I could quickly pull it up on the screen, but I will have to bring it up another time, and took a picture of throwing some money in the dirt with a shovel. And he said, don't call me. I'm preparing for the crash. and I thought, you know, it really is what people want us to buy into in the media. And what many financial firms would like us to do, because they want us to what? They want us to move our money. They want us to pay to get it moving. They want us to invest it in new things. It's in nobody's interest but our own to pick and hold strategy. So here we are, 74 to 94. The growth of wealth in that period of time from $1 is now over $20. What was that one quote? It's no end in sight. Here's the thing I want everybody to sit with. We don't know. We have no idea where the next 20% downturn is going to come. It's going to come. This may not be it. It could be next week. It may be a year from now. But I will tell you for sure, I know where the next 100% move is going to be, and it will be up. Because we're not going to have a 100% wipe out the markets forever downturn. And if we do, having the money in bonds or more conservative investments isn't what's going to get the job done. Okay? So let's look at the next period of time. Now there's our gross annualized return after the crash of 73. Oh, Alex is at work again here. I'll share this with you guys. Yep, here's our strategy, everybody. Dig a hole, throw some money in it. But it really is that there are people out there that they don't go do that, but they do the functional equivalent of having done that, and they miss out on all these rates of return. A 20-year rate of return, as you can see now on the screen, of 16% over 20 years, and all you had to do was be there for it. 69, 70 months, or 7 months, 19% down. The economy is on the brink. It's a world of uncertainty about inflation, business growth. Vietnam and the Middle East weighs heavy on the stock market. They're sick and tired of turmoil and distrust. They won't believe anything until there's a series of turnarounds, and they don't see it so far. Let's say you stayed in. From June 70 to May 1990, for every dollar you have, you now have $14. You had $1 million, you have $14 million. And all you had to do was be there for it. 14% rate of return over 20 years after the crash. 62, 8 months, negative 17%. I'm going to hit the last couple ones quickly so we can get us out at 4:30 as promised. Let's just look. From 62 to 82, 20 years. This is a period of time many people said was stagflation, that the market didn't move up hardly at all. Look what the S&P 500 did. This is the beauty of allocated performance over time. Even a 70-30 U.S. portfolio only is now over 10, while the S&P 500 was only 5. So just redistribution and rebalancing, even in a U.S. only portfolio of 70-30, look how far it outperformed over 20 years. If you start with $1 million, you had $5 million, or if you started at $1 million, you had $11 million. Big difference. No questions so far. Yeah, one of the guys in the office here is asking me about any questions. So here's our rate of return, 12% over 20 years after the crash. 46, big one, 11 months, 20% down. Now this is the only thing that we could find. Secondary sales beat down stock market, meaning people are continuing to sell. Now back in the 40s, it wasn't you know, he wasn't your average everyday person that was getting hurt by stock market downturns. Let's see what else we got. Quotes from 47, I love this. Truman said, "It's a time where nearly everyone in the nation is feeling the pressure. It's far too late to fight against inflation to pace our main reliance upon voluntary action." Wait a second, what happened in the market? Over 20 years, for every dollar you had somewhere between $10 and $16. For every dollar, over 20 years. And all you had to do was, like, you ever heard somebody say, don't just stand there, do something? This is, don't just do something, stand there. As you all can tell by phone, I hope this isn't super loud in your phone. I'm very excited. I wish you could see my face right now. Here's why. Having spent a week in New York, and then I had a chance to go to Yakima, and I spent most of my time in Yakima speaking with either one of two groups, existing clients with their guests, needing to hear some of what we do in our Illusions of Investing conversation. We had 35 people at an event last night. And all day prior to that, I was talking to financial advisors that are pushing much of what I'm telling you we need to stay away from, and trying to bring them to the truth of academic modeling for clients, that we should do everything based upon indisputable math and independent scholarship. So I'm very, very passionate at the end of this week. I'm certainly not wound down. I'm ready to go 2 more days, but unfortunately, they're going to keep the office closed over the weekend because Sherry takes the keys when she goes home. 20 years, 12.4% is a biggie. 34 months, almost 3 years long. Total S&P 500 return, 83%. 83%. You started with $1 million and you dropped to less than 200,000. This is why people were jumping out of windows on Wall Street. Folks, it was terrible. Jumping out of windows. I'm turning on my camera. I want you guys to be able to see my face. I can't believe it. I'm 83% negative rate of return. How is that? How are we ever coming back from that? This is the cover of the news. Wall Street routed. Quotes from them. Some of you have seen these. Country is not in good condition. Calvin Coolidge. Wall Street in panic as stocks crash. By the way, one quick departure. Did you know Calvin Coolidge's son died while he was president of the United States because he played tennis on a clay court with no shoes and got a blister? Massive infection killed him. A lot of people don't know that. But think about that's how different it was in the 1920s. A blister, a small infection, kill you, even if you're the president's son. How far we've come since then. But everybody thought the world is over. Wall Street lays an egg. Wave after wave of selling again moved down prices of the stock exchange today, and billions of dollars were clipped from values. Well, let's say we would have just stayed in from 32 to 52. Once again, just 20 years. We had a world war that also destroyed 3/4 of the world's capital production capacity, and it still came back. If you had $1, you now had 24. Between 19 and $24. You had $1 million and held at the bottom. Meaning, yes, you started with $1 million, you went down to 200,000, but you came back well beyond that and then some. I mean, if you think about this, you started like somewhere up here, and you went down. Let's see, yeah, and you went down to. So if you lost 80%, it'd be 5. Right? To then lose 80% and end up at 1. So you started here, but if you held, you ended up all the way back up here. These are conversations people are not having on a daily basis. Oh, people can't see my pointer. Oh, that's interesting. I will have to figure out how to make sure you can see my pointer. I think I got it. How about this? Thank you for, I didn't see whose name that was. So right down here, thank you, Roy, 5. We would have dropped to 1, and then after 20 years, we would have been back up here. And we would have held on for a lot of volatility. There would have been another slip back here in the late 30s. We would have had a fairly stagnant market. And then tons of wealth creation. All we had to do was be there for it. It's kind of like all we had to do was show up. Now this chart doesn't do it justice. You're going to see here in a moment. Oh, now this is really bad. I don't know how to get my, hang on. Choose pen color, normal, non-drawing mode. There we go. Now this graph looks funny. It's not my fault. This is just how the numbers work. The first year after the crash of 29, it was up 226%. Look how big all the other returns are. They just look small next to 226%, okay? So it's not a small rate of return that it was 17% for 20 years. It's just that it looks really small next to 226, okay? Let's move on. So let's say if just back in December 2008, what you said was, I'm out. It was down 38%. I can't take it. I'm out of here. I got to go. But the 3-month Treasury bills were yielding super, super, super small rates of return. And you bailed out. How long does it take you in Treasury bills to get back to where you were? 2,400 years. Now remember, it took us just like 18 months to get back to pre-crash levels. And yet if we get out, it's that kind of climb. So what do crashes teach us? Historically, markets have always recovered over time, that exact market bottoms are impossible to predict, and that market recoveries have been relatively fast. The single largest historical recovery followed the single largest crash, and the highest historical returns generally follow crashes. So if all we did was we made sure that we stayed in, we were fine. So I'm going to go back to the quote that we started with, is that investors who have either the enterprise or the money to invest now, somewhere near the bottom, are likely to prevail over those who wait for the bottom and miss it. We can't put ourselves in a position where what we do is get out of the market, because we will miss the ability to ride it back up. I'm going to give one more example for a roundtable that I did, and we're 3 minutes over. I'm going to end. At this roundtable, people were talking about, and I've had a unique opportunity to sit around the table with some of the largest asset managers up in the Pacific Northwest. And we all shared some common values, and we were going around the table, and they're like, well, should we get people out of the market, stay in the market? One of the guys is going to buy platinum with all his clients' money. And here's what you'd have to do. You would have been out. Going back to that first most recent crash, if you got out in the 2008, right before the big drop of the S&P 500, and then you wanted to get back in at the bottom, you had to get out mid-September and be fully back in by March. What's that, 7 months? So put yourself in those shoes. You have $4 or $5 million, and you have the guts one day to say, I'm all out. And then a little while later, just 7 months later, you guys remember what it was like 7 months later in early 2009? To take advantage, which was about a 30-point spread between the two, to go all back in the midst of all that negativity, you throttle all the way back in. You'd only have a 30% gain for having been out and got back in. If you waited 1 year, it was a 10% difference. And if you waited 18 months, the market was pretty much back to where it was in September of 2008. So you would, the behavior of getting in and out is nearly impossible to pull off, but here's my last parting thing I'm going to share with everybody. This is the problem with survivorship bias. Somebody's going to get out, or somebody did back in 2008, and they're still beating on their chest about having gotten. It didn't matter if they only had like $40,000 of investments and you have $2 million and you're on track. They're going to say, oh, I got all my money out of the market back in the middle of 2008, right before the big drop, and I just felt great. I didn't lose the 30%. And they're still beating on their chest. And they're going to. People that win like that or believe they won do. But if you ever dug in and said, well, when did you get back in? And how long did you stay in? And did you get a chance? Most of them probably actually got zero advantage from having gotten out, because they got back in at the wrong time or got back in too late. Because remember, if you waited longer than 18 months, you were actually buying higher than what you sold at. So making sure that we're in a structured strategy, passive structured investing theory is what we teach here at Sound Financial Group. Every single one of you can be in a position where you get a chance to partake in the greatest relatively passive wealth creation tool in existence, which is the stock market. You will make money other places in your career, in real estate, in investment, in business, but the only academically way that's proven to be able to generate wealth in the market is to find a strategy. Many of you found a strategy with us here at Sound Financial Group, and then hold that strategy. Because what costs people big is not some of the silly business mistakes they make, and some of those things, it's almost always breaking strategy. I want to encourage each of you in the midst of everything that's going on, and we're going to do more of these webinars to just give you a taste, a little extra bit of financial knowledge as we go through the year. But I want to encourage all of you to know that you've built a strategy, to hold a strategy. And if you're working with a coach with our firm, reach out to your coach and have them help talk you through any of the fears or anything else that's on your mind, because we are here to help you. That's why we exist. And if you're not currently a client of our firm, reach out. You email me directly. You can reach out to me, paul_adams@sfgwa.com. You can reply, I think you got it, with the invite to this webinar. And we're going to make sure that you get connected with one of our team members so that you can have your financial future cared for with the same level of discipline and care that we've just done in communicating this to you in this 30-minute focused learning session. Hope everybody has a wonderful weekend, and we'll look forward to talking to you real soon. Take care. Bye-bye.